In the last video, we looked at the basics of how to do discounted cash flow modeling. In this video, we're going to look at some of the theory of why we do discounted cash flow modeling a certain way. And we're going to do that by looking at three methods: the maximum dividend method, the pseudo-dividend method, and also venture capital methods. So as a recap from last time, if you recall, the important thing was that the discounted cash flow analysis splits cash flows into the explicit period and the terminal period. And we forecast the terminal period, kind of taking care of cash flows from the end of the explicit period on forever. Right? We discounted those back to a terminal value. A reversion value took that back to time zero present value, and then we could value the entire company, security, etc. Right? We also want to remember that valuation is estimation. Right? We are estimating the cash flows using our financial statements, and then estimating discount rates based on the riskiness of those cash flows or the riskiness of that business. And we tend to get those from more market-based measures. So what we're going to do today is talk about kind of how we get those cash flows a little bit more and why we get them in certain ways. So the maximum dividend method is going to be our first method. And that is going to think about projecting cash flows as explicitly dividends. So we're going to build the financial statements to assume we're paying out all excess cash as dividends. If we don't have enough cash, we're going to take that in as an equity issuance, which you could think of as a negative dividend. So we're going to have dividends in and out of the company every period. Not that realistic, but we're going to see how it works from a valuation perspective. We're then going to go on to the pseudo-dividend method, which gives us actually the same cash flows without the unappealing property of explicitly forecasting dividends. We're going to get the same answer from both methods. We're then going to look at the venture capital method, which is really kind of a shortcut method where we just focus on what's the investment today and then what's the exit value in the future. And this is going to tend to be a little bit more of a conservative approach to valuation. So it'll give us a way to kind of triangulate what we think a true value is when we can use both our pseudo-dividend method with a explicit DCF, we can use a shortcut with the venture capital method, and the true valuation is probably somewhere in the middle. Before we get into any of the methods, we need to talk about cash. And we need to talk about it as a required versus surplus cash. Now, required cash, this is what we think of as cash you need to run your business. Or you can think about it as your bank account, right? Your bank account, you like to have that as some amount more than zero, right? You know there's going to be some inflows and outflows, like some days you're going to have to pay a bill, other days you're going to get paid, and you'd like to think of a minimum cash amount you like to keep in your bank account just so you don't overdraw it. Same thing for a business. There's certain amounts of cash that the business needs just to kind of keep everything operating smoothly. You have to be able to pay your suppliers on time, pay your workers, etc. And so the required cash is whatever the amount of the business is that they need kind of to keep on a regular basis to keep operations moving smoothly. Surplus cash, on the other hand, is any extra cash above and beyond the required cash. So really, we're just thinking about required cash as kind of a required current asset. Just like you need inventory to run your business, you need some small inventory of cash to also run your business, right? Anything else is surplus, and that's what we're going to be able to pay out to our shareholders in the form of dividends. All right, so that's an important distinction between required and surplus cash that we're going to need to make. Because if we don't make that distinction, then either we're going to think about all cash as being required, and you can never pay anything out to shareholders, and our valuation exercise is easy because it's worth zero. Or alternatively, we're going to think about it all as surplus cash, and we're going to overestimate how much cash we can actually pay out to shareholders. All right, so on the maximum dividend method, what we're going to think about doing is projecting those dividends as the amount of excess cash or surplus cash we have in every period. So we're going to explicitly strip out those dividends from the company via the financial statements, right? We're going to show in the statement of cash flows, you're going to have a dividend coming out. That way we always keep the surplus cash equal to zero. Now what this does for us is it helps us to avoid kind of an excess cash penalty, right? Because if you have money just sitting in your bank account, right, it doesn't earn that much interest, right? You might earn 1% interest, for example, depending on the times. However, the cost of capital to your company is much, much higher, right? You're presumably running a risky business that may or may not succeed, and your cost of capital is going to depend on the riskiness of the assets that you use and the business and industry that you're in. So as a result, you want to avoid kind of that difference between, say, your 25% cost of capital if you're a small startup versus that 1% you can earn in the bank account. So by paying this out to shareholders, we're basically making it their problem. We're saying we've paid you out your investment, you can now take, or we've paid you out some of your return rather, you can now take that and go invest it in another opportunity. You could put it in the market, you could put it in another startup, you can reinvest in our company if we have an equity issuance down the road, but we're basically moving it out of our company so we no longer have to pay that 25% discount rate on that capital that we're keeping in store. So really, this is like thinking about this as an NPV neutral investment, right? We can basically think about it as NPV zero, that if we give this cash out to the investor, they can take care of the investment on their own. Now, functionally, to implement this, right, you guys have been used to financial statements where you plug for cash, right? So we're essentially solving for how much cash do you have to make everything balance. Instead, here you set surplus cash equal to zero, right? You're still going to have a required cash account. Surplus cash, on the other hand, is set to zero, and then dividends become our plug value that basically make the entire spreadsheet balance. All right, so let's see what that looks like in some financial statements. All right, so here we start out with the income statement. In the income statement, right, there's, this is kind of made up financial statements here, but importantly, what you can see as we get down towards the bottom is that we have this dividend line forecast. All right, that dividend line, while you can't see it quite yet, is being explicitly plugged for or solved for. That way it's going to make our surplus cash equal to zero. All right, it's going to show up on the income statement, also on the statement of cash flows, but here we see it first on the income statement. Now, as we go over to the balance sheet, now we see that surplus cash line is zero across the board. Notice that our cash is also split up into two accounts. We have our required cash and also our surplus cash. So again, that required cash, we can think about that kind of as our cash inventory, right? It's cash that we need to run the business. And while I didn't mention it earlier, where is this going to come from? Well, like anything else on our projected financial statements, from an assumption, right? You're going to have to make an assumption of how much cash do you need to run the business. That might be, say, 20% of our, end of the year current liabilities, or it might be 100% of our end of the year current liabilities, right? But it's going to be or it could be $50,000. It could just be a dollar amount, but it's going to be some assumption that you make and put into the business plan. Again, surplus cash is everything else, but here we're mechanically plugging for that to equal zero. That way the dividends take all the excess. And now we can see that when we flip over to the statement of cash flows. And in the cash flow statement down here, we can see through a combination of those equity issuances and dividends, that's where our plug value is coming in. So notice we have dividends initially are negative about $6,500. Now, why are they negative? Well, from the company's perspective, that's $6,500 leaving the company, right? The investors are the ones taking that in. So it's a positive for an investor, but a negative from the company's point of view. So we have those negative flows from the company to the investor for these first couple of years, right? We have those first few dividends out that, again, are plugging to make sure our surplus cash is zero. Once we get to year 4, we actually see that some money starts to come into the company. So here we didn't have enough cash, right? Our cash balance would have gone negative, and so we needed to raise a little bit of equity from our investors. We then turn around the next period and start paying out dividends again, and finally we have another dividend in the last year of our explicit forecast here. Now, if we turn to how do we value this, well, we take those dividends, right? We have explicit cash flows as dividends. We can then discount them back to present value. So you see in the calculation here, we take that first cash flow, we discount that one period. That's the $65,000 divided by 1.25. We then have each subsequent cash flow that's in the explicit period discounted by the appropriate amount. And then finally, we took that last cash flow, and that's the cash flow that we're going to assume we're going to use going forward in perpetuity. So that we're dividing not only by 1.25 to the fourth, but also by R minus G. In this case, the R, or the terminal discount rate, is 18%, where the terminal growth rate is 6%. So that gives us the present value of the security, right? That's the first equation. The second equation there is actually the net present value of the security. And all I'm doing here is making a distinction that net present value includes your time zero cash flows. Typically, when we look at examples, we're going to have negative initial investments, right? You have to, buy a machine and then see how productive it is to produce cash flows in the future. Or you invest in a stock, you pay for that stock, and you get the cash flows out in the future as well. In this case, we actually had a positive cash flow at time 0, but that's still going to reflect then the net present value. All right, let's actually take a minute and look at a slightly different example from the context that we were working in the previous video. All right, so in this example, we're building from the exact same thing we had before. We're just going to change a few things on terminology here. Right? The first thing is that this line is now reflecting dividends that we're projecting. Right? So assume we have some statement of cash flows out there. That statement of cash flows gives us these dividends. In this maximum dividend method, we assume that those dividends are our valuation cash flows. To then get them back to present value, right, we discount them the same way we saw in the prior video. Right? Each of the explicit cash flows are discounted back to today based on how far in the future they are, right, from 1 to 5 years. And then we also estimate our terminal value, again, using our stepping stone year, or the start of our terminal period cash flow, divided by R minus G. Remembering that we take that terminal value, it's a time 5 value, so we take that back to time 0, we call that the reversion value, and add that all together to get the present value of our security. And in this case, we can really call this the net present value, because we've included that time 0 investment as well. So in this case, this is the maximum dividend method. And really the important thing is that we're explicitly forecasting our dividends from our statement of cash flows, and those are our valuation cash flows in this case. Now there are some shortcomings to the maximum dividend method. The first one is that we don't actually expect to forecast, to pay out these kind of varying dividends every period. The way companies work, typically when they set a dividend policy, they try to keep that dividend nice and stable over time. That way investors who rely on that dividend stream for income can have a reliable source of income, right? So essentially they set a dividend policy and try to maintain it. They don't increase the dividend when they have extra cash and then decrease the dividend when they don't have enough, or even make it go negative to raise money when they actually need more cash. So it's really rare to think about this volatile dividend structure. So that's really not very realistic. It's also not realistic to think investors are just standing ready to put more money into the company at the drop of a hat, right? Going to the market and raising equity is a time-consuming and expensive process. So it's not something that we want to think about explicitly doing every time we need a few extra bucks of cash. So really, from two perspectives here, it's not really reasonable or appealing to forecast explicit dividends. Instead, we'd like to think about, can we get those cash flows somehow out of the financial statements in a different way so we don't have to think about explicitly forecasting the dividends, right? The strength of this method is that we can conceptually think of them as dividends, and then they are the cash flows, right? So that's the nice conceptual link here. Presentation-wise, it doesn't work well, but it turns out it really is just a presentation issue. So when we go to the pseudo-dividend method next, we're going to see that we get the exact same cash flows out, just in a more kind of palatable way with financial statements that look very reasonable and aren't going to raise questions from future investors who say, hey, why are you paying out dividends every quarter? Or why are you going to ask me for more money 3 months down the road? So it creates a much more reasonable set of financial statements with ultimately the same valuation.